So, Doug, here we are halfway through 2022. So, it seems like a good time to do a little recap of what we've experienced, this roller coaster that we've been on for the first half of the year, and talk about where we think things are headed. So, can you start us off?
Yeah, so far this year it's been pretty rough. We're down around 20% right now as
The
last
S&P.
in June. The S&P 500 is down 20%. Technology stocks have taken it even harder. It's been a
Definitely.
rough year for technology stocks. And it's been a pretty decent year for the commodity sector, which is what we saw. Inflation is running about 8.6%, and that's really high by historic levels. Even if you look at the overall history of the United States, inflation is usually about 4.5%.
That's like an average. In the last decade or so, it's been even lower than
Much
that.
better, 2 and 3%. So it's inflation's definitely a big concern. And so we kind of saw that on our dolly early in January and February. We started actually talking about commodities, mainly oil, natural gas, in February. That's when we started moving clients into oil, natural gas, and that was the right move. But we should probably talk about what the dolly's telling us right now.
Yeah, so we have it pulled up here. We can see that commodities are still at the top. Just a reminder for our viewers, the dolly helps us see what is actually moving in the market, and it lists the things that are moving the fastest or growing the fastest at the top and then going down from there. So commodities is in the number one place still, with energy and then agriculture being still in the green. Precious metals and industrial metals, we had talked about industrial metals a little bit earlier this year, but they are not doing as well. We have cash next, which is a little crazy given the inflationary environment.
And that just switched last week. Right.
And then from there, domestic equities, mid-cap value, small-cap value, of course, energy here again, domestic energy, domestic consumer non-cyclicals. And of course, people are starting to tighten their belts, so we know that consumer non-cyclicals, things that people absolutely need for survival, groceries, that sort of thing, are doing well right now because people obviously can't go without food, but discretionary purchases are certainly going by the wayside as gas and other things eat more into the monthly paycheck.
Yeah, so as we've said earlier, the first quarter was negative GDP. The second quarter hasn't come out yet, but I suspect it's going to be negative GDP, which means we're in a recession. So when people are in recessions, they still buy food, alcohol, soft drinks, but they won't, as you said, they won't buy, say, a new washer and dryer if it's still working. So basically, we should talk about what we believe and what we should be doing. Maybe you want to kind of talk about that.
I mean, we've talked about the fact that, you can line up 10 super smart analysts and they'll give you 10 different answers. I mean, no one really knows where the inflation will end and whether or not we'll have a soft landing or a recession. Arguably, we could already be in a recession. The nice thing about that is the market starts to come back much faster because it's forward looking. So if we are in fact in a recession, that means hopefully we're getting closer to the end of the negative returns that we've been seeing this year.
So one of the things we've been using as a comparison is 1970. In 1970, at the end of June, the market was down exactly 20%, 20.5, I believe it was, and inflation was running about 7.5%. So inflation was similar to where we're at today. The market's down the same amount. And the market actually ended up a little bit, about 1%.
Yeah.
It was a small increase. We were kind of looking at that, which means that the market came back a lot from the bottom of June, where it's down 20% to where it's up about 1%. So that it means it was a really nice second half of 1970. And I kind of think that that could happen again. But we also follow our discipline, which the Dolly says right now we want to be heavy in commodities. We want to actually consider raising some cash right now, small amount. And we want to be also looking in that consumer non-cyclical area, the food and alcohol.
Now, these are shorter term plays though. So if you're someone, say like me in your 40s and you know that, okay, in my IRA or my 401k, I'm not gonna be pulling money out of that for another 20 years. Would you say the same thing, or would it be a different?
Good question. So the answer is no, I wouldn't. I would, and we've been saying this all along too. Great companies that are selling at a big discount you want to own, and these would be some of those big technology, healthcare, those type of companies that are, growing at 25% a year, have no debt, and are down 30%. What a bargain, especially if you're someone in your 40s or 50s looking at a longer term than say 1 or 2 years.
Right.
So we've kind of said in the past you want to have money in commodities, but then you also want the bulk of your money in high quality, low debt stocks. We still say that. The only difference now is that you probably want to add some of the consumer non-cyclical in with those commodities, and you might even consider raising some cash if your time frame is shorter.
Right. I think that's an important distinction.
Right. So we want to thank you all for joining us here in the Charney War Room, and we know it's a very difficult time. We appreciate you being with us as clients, but if you have friends that need a second opinion or worried about what's going on, please send them our name and number and we'll be glad to talk with them. Thank you.